Hello everyone, this is Orhan Erdem. In this video, I'm going to introduce you my new book After the Crash and briefly summarize it. The book mainly talks about economic and social consequences of 2008 crisis, and I'm going to tie these consequences to today too. So the consequences of 2008 crisis from now on, which I will call Great Recession, had been so fierce that GDPs of the countries shrank like around 2%. So even it was even worse for advanced economies too, which you see in the graph. It was negative 4 or 5% for European Union countries and high-income countries. So ex-Federal Reserve Chairman Ben Bernanke referred this crisis the worst in global history, and it was so fierce that the economists are comparing it to 1929 Great Depression. So you can see in the graph the S&P 500 index, which is one of the benchmarks indices for stock markets. The stock market index decreased almost 56%, 1.5 years after the peak in 2008. And the same thing, the same index was 45% during Great Depression after the 1.5 years after the peak. So you also see global trade after 2008 crisis. As you see in this graph, the global trade as a share of GDP did not increase. It even decreased from years to years after the crisis. So the crisis do not always result in economic consequences only. These are some economic consequences. The crisis marked the beginning of a new era, which was associated with new understanding of theoretical and practical economics, as well as social and political lives. So the book analyzes these consequences in a couple of titles. The first one is The Changing Understanding of Economics. So as you might know, the mainstream economics assumes that people are rational and they decide rationally. I think the first consequence of the crisis was showing us people might not be as rational as the theory predicts. So the theory says that there can't be any asset bubbles just because if some people realize that there are asset bubbles, there are overvalued assets, they would short sell these assets, decreasing the prices in return. So as you see in this graph, during 2008 crisis, the house prices doubled before the crisis, of course. So doubled in the last 10 years before the crisis, in almost 10 years. So stock market tripled, and nobody realized this bubble, and all of a sudden the bubble burst, making people less wealthy. Some economists before the crisis have been saying that people might not be as rational as theory predicts. So there are a couple of examples, one of which is here, Cuba Mutual Fund, CUBA in fact. I borrowed this example from University of Chicago professor Richard Taylor. So CUBA was a mutual end fund, mutual closed-end fund, traded on Nasdaq Stock Exchange. So this example kind of shows us that people might not be as rational as our theory is saying. So closed-end mutual funds raise money from people, if you don't know, first, and then use that money to invest in shares traded in stock exchanges. So despite the name CUBA, like Cuba, it has nothing to do with the country. However, the similarity in the names influenced the US stock market. So in December 2014, President Barack Obama relaxed the restrictions against Cuba, the country, which was imposed in 1960s. And during that day, in 2014, exactly December 18, 2014, when the restrictions against Cuba was relaxed, the price of the mutual end fund, this CUBA mutual end fund, increased from $6, which you can see in the graph, increased from $6.20, okay, to $12.70 overnight. Okay, so doubling its value. However, there was no overnight changes in funds, profits or assets. It had no investment just because they didn't do anything. However, even though the mutual funds assets and profits did not change, people kind of confused with the name. So when President Obama relaxed the restrictions against Cuba, the Cuba price almost doubled overnight. So the political news about Cuba, the country, doubled the CUBA's share price. So it was an irrational excitement, which kind of made people rush to buy their shares. So you might have a reason to say, isn't it possible that everybody was confused that day, including the giant investment companies? However, the prices did not recover next day, nor the day after. It almost took a year for the prices return to $6 levels. From here, okay, to here. It took almost a year. Okay. So according to Professor Taylor, this phenomenon pointed out how irrational investors were behaving. So these are a couple of examples that has been used in a sub-branch of economics, which is called behavioral economics, for years, since the 70s. So these economists are saying that humans are not as rational as we assume. So, but they were not heeded. So the crisis made us kind of aware of these unheterodox theories and ideas. So one of the consequences of the crisis was kind of embracing these other theories. Okay, so the other thing is capitalism is kind of into disrepute. So people started questioning the free markets. So markets do not always correct mispricing, which is one of the assumptions of economics. So here is a kind of quote from a public hearing. So Congressman Henry Waxman is asking, my question is very simple. Were you wrong? This question was asked to ex-Federal Reserve Chairman Alan Greenspan. He said, partially I made a mistake in presuming that self-interest of organizations, specifically banks, of course, is such that they were best capable of protecting shareholders and equity in firms. So he said he discovered the flaw in the model. So yeah, so this model is the mainstream economy. So the mainstream economy started to be questioning after the crisis. The other thing is kind of losing the people's trust, like public's trust. Government insured private institutions against the consequences of their folly. There were massive bailouts like Bear Stearns, AIG, Fannie Mae, Freddie Mac. They were bailed out, but not the Lehman Brothers, of course. So Republican Senator Jim Bunning of Kentucky said this massive bailout is not a solution. It's financial socialism. Okay. So this kind of, I'm trying to make my point, which is saying that the free markets idea is kind of has been questioned, especially after the crisis. Another economist said, I believe that the root cause of the present crisis lies in the intellectual failure of economics. So all of these questioning, like the disrepute and losing people's trust, started to kind of open a new era. Okay, so once these free markets idea is being questioned now, and the government interruptions started to be happening, we kind of moving from free markets to a different point. So Manuel Funke from John F. Kennedy Institute at University of Berlin, together with a couple of his colleagues, find in one of his research that after financial crises, democratic tendencies weaken, political polarization of extreme right parties increased by an average of 30%. And some people, some scholars saying that liberalism seems to have failed. So just because when there is a crisis, governments have all the excuses because of the severity of crisis, of course, to intervene in the market, bypass the laws, and even sometimes the human rights. So the economics, the failure of economics and government interventions, and then the failure of free markets, everything kind of became an excuse for governments to move from the free markets to authoritarian governments. So that's why I believe this pendulum between free markets and total authoritarian regimes, this pendulum is kind of passing the halfway through authoritarian regimes, and we are moving toward that direction. So I have a couple of evidences. So several think tanks confirm that the global shift toward authoritarian regimes. So they confirm this. Freedom House is one of those. They report that the percentage of not free countries, which was almost like 22% during 2008, this percentage has increased from 22% to 26% in 10 years. So the number of not free countries has increased. The tendency toward a more authoritarian government can be observed by looking at this graph. Also, this is from another think tank, which is The Economist, the magazine. The number of democratic countries decreased from 30 to 20 from here to here. So these are evidences showing that authoritarian regimes are on the rise. So there might be a couple of examples, one of which is Turkey. So it was a flawed democracy according to the Economist's index. Now it's a hybrid regime. There was a national emergency between 2016 and 2018, but President Erdogan of Turkey, he gained enormous powers during 2017 elections, which was held under national emergency. Now he has unprecedented powers and can appoint ministers, senior civil servants, and university rectors. There are a couple of other things which I'm explaining in the book. I will be skipping it right now. Hungary is another example. Prime Minister Viktor Orban said what we should view as our starting point is the great distribution of global financial, economic, commercial, political, and military power that became obvious in 2008. So Hungary has been switching from a free state to a maybe partially free state too. There are a couple of other examples which I explain in the book. The freedom score of Venezuela, Turkey, Serbia, Hungary, and even United States has been decreasing after the crisis. This is another graph from Freedom House too. So they have tracked a global decline in the total U.S. score over the past years after the crisis. So this is United States score. They say they conclude that democracy has been eroding in the United States too. So even fully democratic countries are moving from totally free and totally democratic regime. Computer and technology is helping the governments move to the authoritarian direction too. So Harari says, as algorithms come to know so well, authoritarian governments could gain absolute control over their citizens, even more so than in Nazi Germany, and resistance to such regimes might be utterly impossible. After the crisis, people, as I told you before, lost their trust in financial institutions just because the government has been bailing down some institutions, but not the others. So here you see the confidence in banks in the United States. So the government the government saved the economy but lost the public was a quote from former president of New York Fed, Tim Geithner. He said this just because individuals were not helped. Okay, so look at the confidence in banks, which was around the percentage of people saying that their confidence in banks is a great deal or quite a lot, was around 53%. But after the crisis, it has been decreasing and decreasing. In 2016, it was around 27%. So another consequence of the crisis is the blockchain technology and cryptocurrencies, the first of which is Bitcoin. Bitcoin was launched, it's really interesting. Bitcoin was launched in 2009, just after the global crisis, when people have started to lose their trust in economic regimes. According to Gallup survey, as I showed you a moment ago, people lost their trust in banks. So that's why this guy who invented Bitcoin, his name is Satoshi Nakamoto, he said that he created a currency that was impervious to unpredictable monetary policies, as well as to the predictions of bankers and politicians. So Bitcoin is kind of created just because of the antitrust of people. I'm not saying Bitcoin is good or bad, but I'm saying that people's trust created, people's lost trust created Bitcoin. One of the premises of capitalism is private property, which allows people to own things and assets from which to make a profit. But they are like, we have been observing several institutions, companies, and firms which are using a system which we can call a sharing economy to help people. Okay, so here's an example. So there is Chicago Tool Library in Chicago, and there is Toronto's famous tool libraries. There are a couple of other examples, but they kind of emerged after the crisis, and they use honor system for their membership. You pay what you can, for example, in Chicago Tool Library, and then you do not need to prove your income. And then you share their tools. You use their tools for like sharing and borrowing a book from a library. So sharing economy is also a rebellion to the consumer's lifestyle, and subscriptions were a threat to ownership. That is what I have been saying in this book. So without the crisis, these would never have been created. So people who lost their wealth started to invent new ways of like using tools, like using hotels, using cars, etc. So sharing was not invented after the crisis, but it made people embrace the concept more rapidly. That's what I'm saying. So Airbnb is, for example, is a potential threat to hotels, while Uber undercut the cab business, etc. There are a couple of other examples. So the appeal of the consumption-based economy has been decreasing. So this is another consequence. Basically, these are the main consequences of the 2008 crisis. The first one is changing economic theories. The second one is shift from free markets to authoritarian regimes. Third one is cryptocurrencies, and the fourth one is sharing economy. So these are the consequences of the 2008 crisis. They did not emerge just because of the crisis, not all of them, but most of them, yes. Some of them developed just because of the crisis. They were there, but I mean, people were not using sharing economy, for example, but they were mainly supported by people's lost trust. So that's all about my book. I hope you enjoyed the book. Have a great day.